Technology companies are spending over $700 billion this year on AI. It is the largest infrastructure build-out in human history, requiring an endless supply of chips, data centers, and power plants. Historically, big tech funded its own expansion with spare cash, but investment firm PIMCO estimates that capital expenditures are now consuming roughly 94 cents of every dollar of free cash flow generated by the business. To maintain this pace, they are borrowing heavily. In just the first 5 months of 2026, the biggest tech firms issued over $159 billion in corporate bonds. Almost overnight, the technology sector grew to represent 18% of the entire U.S. investment-grade debt market. This rapid expansion is eating the vault, turning some of the world's wealthiest companies into some of its biggest borrowers. But when you calculate the total cost of the physical infrastructure being built, the numbers do not add up. The record bond sales and the depleted cash piles still fall short of covering the actual price tag. Reported corporate debt sits at about $1.35 trillion, but estimated off-balance sheet obligations, the debt hiding in the fine print, are currently around $1.65 trillion. The hidden debt is now larger than the debt openly reported to investors. Big tech is utilizing the same shadow banking machinery that economists identified before the 2008 financial crisis, deploying specialized financial structures to handle massive leverage outside of traditional balance sheet oversight. To understand how this works, look at a deal called Beignet Investor. This is a $27 billion financing vehicle specifically constructed to fund Meta's highly specialized Hyperion data center in Louisiana. By every physical measure, this is a Meta project. Meta designs the facility, builds it, operates it, and is expected to be its sole tenant. This diagram illustrates a special purpose vehicle, or SPV. Rather than owning the facility outright, Meta takes only a 20% stake in this central corporate entity. Outside investors like Blue Owl hold the remaining 80%. Because this SPV is technically a separate legal entity, it goes to the open market on its own and issues roughly $27.3 billion in investment-grade bonds to fund the actual construction. Under accounting rules, Meta is not considered the primary beneficiary of the venture. That massive debt load never actually touches Meta's official balance sheet. Instead, the debt is quietly serviced by the rent Meta pays to the SPV to use the building. This legal architecture allows tech companies to build out the largest infrastructure in history while legally separating themselves from the underlying debt on paper. But the separation is an illusion. Very deep inside the footnotes of Meta's annual reports is a disclosure regarding residual value guarantees. This chart tracks the facility's value against a fixed threshold. If the value of the specialized data center drops below a guaranteed $28 billion, Meta is legally on the hook to pay the multi-billion-dollar difference directly to the lenders. The economic risk remains firmly with the tech company. It is equivalent to taking out a loan in someone else's name to keep it off your credit score, while secretly signing a contract promising to bail them out if they fail. Beignet is not an isolated case. Tech giants are executing identical structures, like Project Sophia, repeatedly deploying the same 80-20 data center arrangement across the industry. Legal researchers identified more than $120 billion moved off balance sheets in less than 2 years. Moody's has identified nearly $1 trillion in legal commitments connected to future AI data center leases. This single accounting loophole has become a viral blueprint, transforming a specialized case study into a trillion-dollar industry vulnerability. The sheer volume of off-balance sheet debt is staggering, but it is not the primary danger. The true risk lies in exactly who is providing the capital. A highly concentrated group of the exact same asset managers and banks are repeatedly funding these specific structures. This visualization shows how market risk concentrates. When 5 separate tech companies make the same infrastructure play, and those loans all trace back to the same lenders, you no longer have 5 independent bets. You have one giant bet written 5 times over. This concentration mirrors the shadow banking vulnerabilities that preceded the 2008 crash. For this financial machine to survive, 4 things have to go right. First, current AI revenue, around $110 billion a year, must scale to justify the $700 billion annual spend. Second, the returns on cloud investments, which have recently fallen from 40% toward 20%, must stabilize. Third, the broader credit markets must remain stable. Morgan Stanley estimates total infrastructure costs could reach $2.9 trillion through 2028. Cash flow only covers half of that, leaving a $1.5 trillion financing gap that outside lenders must fill. Finally, the American power grid must handle the load. Major power markets are already facing serious capacity constraints, which could become the next bottleneck for these massive facilities. If revenue lags or the grid breaks, the trillions hiding in the footnotes will suddenly matter far more than who won the technology race. The ultimate question is simply, who is left holding the debt?